Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. In today's episode, I dive into a topic that's of great personal interest to me, and that is, in a world where mutual funds enjoy so many tax advantages over direct stock ownership, investing in a PMS, or subscribing to units of an AIF, why do all three of these still exist and thrive? And why or when should you choose one route over the others? In today's chat, Deepak goes into when mutual funds work best and how folks often end up with too many mutual fund schemes and individual fund choices that are themselves far too conservative for what they'd like, how PMSs fare on taxes and how they try to make up for this disadvantage with more concentration or investing in names that might be too small for a large mutual fund, when AIFs do well, which is when they tap into unlisted equities, leverage, and use less transparency to their and your advantage. And finally, how factors like if you're an NRI, where you're a tax resident of, what stock ownership restrictions you have from your work, how these very much play a role in which vehicle you should choose to invest in. So folks, do listen in for MFs versus PMS versus AIF. Deepak, mutual funds are particularly great when it comes to taxation. This has come up recently because after we got our in-principle approval, a few people reached out to me saying, hey, so you folks already have a PMS, you already have an AIF, and maybe one day you'll be launching, hopefully, a mutual fund as well. So supposing I like you guys, or I like Deepak or whatever, which one of your products should I invest in? And this really got me thinking because I've had many interactions with folks at, I guess, different asset and income levels. And what comes to mind to me is when you just do a specs comparison of the mutual fund versus these others, say a PMS as an AIF, the mutual fund should be winning hands down, right? Because it's great on taxes. I mean, if the mutual fund buys and sells a stock, it doesn't have to pay any taxes. You only pay when you redeem. The fees are generally lower than most PMSs and AIFs, although I will mention that the Capital Mind PMS is as low or a bit lower than most mutual funds. It's certainly very liquid. I mean, we're talking just a couple of days, sometimes even the next day when it comes to liquidity. And to the extent it matters, you don't even need a demat account. And I guess where that actually helps is you can do this at 9 o'clock at night and it's fine. Unlike, say, having to open your brokerage account and whatever. So all this is so nice on paper. But the fact of the matter is whenever I go and meet people of any means, pretty much no one ever does this. I don't see people investing huge corpuses just into a basket of mutual funds. And in fact, one of the successes I've enjoyed is when in Capital Mind in the PMS, we created the all-weather equity portfolio, which took our ability to rank different mutual funds and created a basket of mutual funds across different categories. And that's done fairly well. I think it's almost made something like 50% in the last year. Of course, everything is up, but it's up too. But even then, the people who come to this are people who seem to not want to own stocks directly. They're either lawyers or they work at, say, some regulator or something, and so they don't want to be associated with direct ownerships of stocks. Or people who are very wealthy and are like, I just don't want that headache anymore. But by and large, it's sold as a solution for people who don't like owning stocks directly. So this is all me leading up to the question, if mutual funds are so good on paper, why aren't they the default go-to for pretty much everyone?
Shray, we have a potential offering in all three. We have a PMS, we have a running AIF, and we hopefully will launch a mutual fund like you said. So I can't favor one versus the other, so I'll try to be as diplomatic about the answer without losing the essence of it all. I think the products exist for different sorts of people. It may not necessarily be that the sorts of people that it is designed for are the only ones taking it, but I'm just going to give you this. Now, you have explained the concept of a product that is all-weather equity. And why does it not own stocks? Because it owns mutual funds. Mutual funds were created because it was complicated to directly own stocks. You didn't know how to select between 5,000 stocks, which stocks to buy. So you said we'll appoint a mutual fund manager, he'll do all this stuff, right? Now there are 5,000 mutual funds. So now you have to figure out which mutual fund to invest in. So a PMS comes in and says, well, I'll help you figure out which mutual fund to invest in. And we've created this portfolio of 6. It's been about 2 years. And in the 2 years, it's done a very good return. Last 1 year is more than 45%, like you said, and so on. The all-weather equity was not designed for as a portfolio we wanted to actually sell to people, like listed on our website and say, oh, this is great and all that. We didn't want to do that because it was primarily designed for people who said, well, we can't own directly stocks and all that. But over time, we figured out that this is a great tax efficient product as well, because the mutual fund, like you said, does not pay any taxes on sales when it buys the stocks and sells the stock. Neither do you pay any taxes as an investor, neither does the mutual fund itself, because the mutual fund itself is not a trust, is not a taxable entity. So effectively, whenever you sell your stocks, your mutual fund, rather, the mutual fund, you will pay tax on the difference between your buy and your sell price. As long-term capital gains tax in equity and in debt, there's no concept of long-term capital gains tax. So it's always a short-term capital gains tax right now. But interestingly, you have all of these this mechanism that makes a mutual fund really attractive from a tax perspective. Because if I can say, oh, I made a huge return, but then if I have to pay this 20% tax because it was all short-term capital gains, in my mind, I discount the return down by 20%. Whereas if I have a mutual fund, even though I will have to pay 12% tax on the returns when I exit, I don't discount that 12% when I see it. And I say, oh, I made a 40% return is equal to a 40% return. It's not 40% minus 12% of that 40, which would be make it like 35%. So it's basically that is a big differential between a mutual fund. I think it's both psychological and real, I mean, in terms of taxes. So, but what you've actually got is a PMS that invests into mutual funds. Isn't it like, oh, PMS could buy stocks, but it's buying a mutual fund instead? Of course, our costs are 1/4. Our fees are 1/4 what we charge for a regular stock portfolio, because the mutual funds themselves have an expense ratio. But interestingly, this model has actually worked really well, even post our fees. Like I said, the 45%, like you said, the 45% return
is post all fees.
Yes. So that's pretty good if you ask me, for something where the S&P or the Nifty 500 has done about 41% or something like that in the same time frame. Now, because of this, you get another advantage. So if you invest in, say, an FD will give you returns in terms of an interest every year, and that interest is taxed, even if you're not using that money. A mutual fund, on the other hand, if you give it the money today and it invests in an FD or a bond, and it gets interest, the interest is not taxed. So it accumulates interest and reinvests that interest without taxation. So the compounding effect of the non-taxed portion, or the tax portion which would otherwise pay as tax, can be a significant amount. So it is 8% versus 5.4%. In terms of taxation and all this. So you might end up saying that, listen, I will get a much better return in the long term if I were to use an 8% return roughly. And of course, in the end, whenever I sell this mutual fund, I will pay tax, but I could defer it. So mentally, it's kind of putting it in the same thing. Now, let's add this to another layer. And I say, listen, as a PMS, I can say you need to be 50% equity and 50% debt. So 50% I buy you the all-weather portfolio, no taxes, and I can buy 50% debt as debt mutual funds, which would be... Now, what I've done is asset allocation on top of a mutual fund. I could do an asset allocation in stocks as well. So essentially, what we've got is a product that can behave like a mutual fund by buying stocks directly, or a product that can behave like an asset allocator on top of mutual funds, which is in a way what a mutual fund of funds may do, but except here it is dynamic and it is related to you. So it's not like if I have a 50-50 allocation, it is for Shray Chandra, but if Vashisht comes, I'll say, oh no, you need to be 80% in equity. So I could do 80% equity and 20% for him. So it's like a customized asset allocation framework, right? So now, if you had done this yourself, if I had bought stocks for you directly and bonds for you directly, the taxation impact for you would be much worse. But as a PMS, I can choose to buy these mutual funds instead for you. And then my taxation impact is substantially lower. So effectively, a PMS is a managed account. It is something that is bought in your name. And whatever restrictions apply to you as an individual also apply to the PMS. So when you yourself go and buy and sell stocks, you have to pay taxes. But if you give to a mutual fund that does the same thing, it doesn't have to pay taxes. You give to a PMS, because the PMS is behaving as you, it is subject to the same taxation as you. So you are currently inconvenienced tax-wise compared to a mutual fund. And so why aren't people
flocking endlessly to mutual funds,
going.
saying, I will save the tax and the headache, and this is so much better?
This is a great point. And I'll tell you one of the other taxation. Before I go down this route, let me just explain on the AIF front. Now, AIF is actually slightly better than the PMS because it, of course, is taxed. Because unlike a mutual fund, an AIF is an entity that is taxed. So I'm talking about category 3 AIFs. Okay. This is okay for you if you are an Indian resident, because what happens over here is that you put your money into an AIF, the AIF, let's say 100 rupees you put into an AIF, it goes to 120. The Indian government says, okay, you know what, pay me 10% tax. I don't know, I'm giving you a number. So 118 is left over. Then you can take out the 118 and the 118 is yours without taxation at all because of the way the structure of an AIF is. Indian government says the AIF has paid the tax, so you don't need to pay. Fine. But let's say you're an Australian resident and from Australia you're investing into India. To Australia, you've invested in something at 100 and you're taking out 118. They don't care that the Indian entity has paid some tax. It's a separate entity. So they're like, listen, you put it in something at 100, you took out something at 118, so you're going to pay tax on that 18 rupees also, which means another 20%. So your effective returns are taxed twice, once in India and once in Australia, which is worse. So depending on who you are, one instrument may actually be better than the other or equivalent to the other and so on. And therefore, the same Australian resident would do better as a PMS with a PMS, because the PMS at least taxes in your name and taxes paid in India are offsettable against the taxes paid as long as the name is exactly the same. So in that context. But, and the big question that you asked was, why aren't people just flocking to all of this and all that? And I'm going to be a little facetious here because I think this is not an easy question to answer. But one is, let me ask you, or let me say that this is equivalent to why I think maybe ice creams and cigarettes exist. So it's I know it's a little weird, but cigarettes have no positive effect on the body. I mean, in the short term, maybe.
No, done.
At some point, it causes cancer and all that stuff. But there is some pleasure involved in having it. So therefore, it is something that is involved with it. Same with ice creams and same with something else. And with expensive clothes, you can argue that clothes are the same regardless of what, but you have one set of clothes that costs 70,000 rupees and one set of clothes that costs 70 rupees. And, they're all the same, but so there is a difference in terms of appearance of glamour or an appearance of pleasure that happens when you use something more effective. This is the worst reason to buy a PMS or an AIF, is that, I own a PMS, so therefore I must be rich.
In all the years of running the PMS, I've never met a customer who wants to own a PMS because they're rich. But okay.
Yes, correct. I think it's a terrible reason to, but many people actually think of it as an upgrade. I am only doing mutual funds, and when I'm rich enough, I should be doing mutual funds. I'm like, no, PMSs. But I'm like, no. When you're big enough, you actually have more of a reason to not have to pay taxes like crazy. But yes, so this is the worst reason. There's no this thing. But let me tell you the real reason, and this is by far the simplest thing to understand. Do you care about PMS versus MF versus everything else? If you said the mutual fund did about, say, 45% in a year, our active portfolios did 59% or so. So if you did a 59% return versus a 45%, you take your 20% tax. 59 by 20% is probably another 10%, 49 or something like that. But of course, there's a differential in tax is only 7.5%. So that means, so even if you did that, you'd get some 52 or 53%, which is way higher than 45%, right? And on the 45, you'd pay tax. Assuming that you do, it'll come down to 41 or 40. And then you're talking 53 or 52 versus 40, which is a fairly big. So I'm saying post fees, if your returns are substantially higher, and we calculate this over in a 5-year period, our PMS needs to beat the index by roughly 3%. If the index gives 20, or give 23. We've actually given 28 or something. And that is specific to us because we have a PMS where we charge only 1% fee per year. Of course, somebody who charges you a profit share and more than 1% fee, then the numbers may be slightly different. But by and large, if you look at a PMS and says, well, it's beaten the daylights out of a mutual fund, then why does it matter to you that it's a mutual fund? And even if you put the taxes and extra components in and it's still beaten it, that means you actually end up with more rupees in your wallet at the end of the day. That is a good reason. Because you're like, this company will beat this mutual fund will be beaten by this PMS over a long period of time. And we have seen this in many PMS where consistently you've had a better one. Now, it's a little bit like saying, I pay more money to get a better car because my fees are higher or whatever. But I'm like, well, it's a better car. It's, if it's a better car, then you're getting more value for it. And therefore, PMSs need to work on bringing more returns. So that, that's one thing. Now, that's PMS. Now, let's take an AIF. Okay? You have an AIF, for instance. The AIF can do a bunch of things that a PMS can't do. For instance, it can invest roughly 25% of its money in unlisted companies. You might say, okay, we've discussed this and said, okay, it's almost like charity. But there are a lot of startups that do pre-IPO rounds, which are very visible rounds. And you might be able to get in your single investment 75% listed equity and 25% unlisted equity, which is great.
And because you could perhaps get a pre-IPO pop on that, and that will be a fantastic annualized return or something.
Annualized return. And you get access to these startups before they actually list, which is pretty good. In some cases it's pretty bad. But I'm just saying that the manager probably knows which are good or which are bad. The problem with many of the non-pure startup investing AIFs has been that they seem to be more about charity or about building the environment than it is about returns, because they'll tell you something like, oh, we've done 4x returns in 10 years. So you're looking and saying 4x return in 10 years is like 14% a year. And that's not meaningfully big enough for me to, plonk a large amount of money on something. But, unfortunately, that's the thing. So it's a 4x return is considered a good thing, or a 5x return, and in 10 years. And you're like, for a 5x return, why would I even go to private market? So don't I need a 10x or 20x return? But nobody's asking those questions yet, and especially not in India. So we'll leave that aside. So we're talking only about Cat 3 AIFs, which can invest mostly in listed startups, 75%, and listed companies, and the return. Now, the important thing over here is that we don't charge you a profit share. So our returns look good. So if you make 59% after fees, you made 59% after fees. What many startups do, or many PMSs do in this space, is simply to say, I will take 15% of your returns as a profit share. That means if I were paying 59%, I take about 15% of that, which could be 1.2. So net return after fees is for 47%. Now, at 47%, if I'm paying taxes, which are meaningfully higher, then the difference between that and 45 does not come out to be so meaningful, right? So I think the important thing over there is we would have been very happy because we would have earned 12% of your 59. I mean, a reasonable percentage of 59, but it would have made you unhappy over a longer period of time. I think that is where people get very confused. So what happens over here is the richer people go to the PMSs, they have these complicated structures, and they tell you, you know what, we're going to take 15% of the profits. You're incentivizing us to make money for you and so on, not realizing there's no downside. So it's only upside. That means I participate with you on the upside, but if you lose money, you lose money. So this realization typically happens a little bit further down the road. And we've seen this where people have come to us and said, Deepak, this is all great, but I don't want to pay the hassle. I mean, I'm coming to you because I went to this other PMS which has a profit share, and their returns are just the same as yours, but then their profit, post the profit share, they're much worse. So they come to us. But tomorrow they might come to us and say, well, you know what? You're a PMS, but I'm getting a better tax advantage as a mutual fund. So it's probably a learning curve where the relatively rich eventually go down to the mutual fund route, but they find the glamour and the pleasure in the personal ownership of mutual funds, of PMSs. And that's what makes them, kind of more attracted to it.
I'm going to counter you now. I mean, because I've actually noticed that, again, your point is well taken. I mean, to summarize, you've said a PMS can very much do investing or a style of investing that allows it to beat a mutual fund, and then you'll be better off obviously by investing in a PMS. And an AIF has certain levers. I think you mentioned the one around unlisted equity, and I guess in theory it even has some ability to do leverage up to some extent, which could also hopefully help the returns be better than the comparison. But now let's go to the MF, which I mean, I'd sort of like led my questions with saying, isn't this the best investment possible? Let me tell you a few things I've noticed which makes it look not that great an investment. The first is when people do mutual funds, they end up doing a lot of mutual funds. So even though they may have found, say, the one quant mutual fund right now, the fact is it's so diluted with all 10, 20, 30 of the mutual funds that they own that A, it's very hard to track which one is doing well, and B, the average return, which is kind of the number you have to compare against, is not all that much better. It's quite middle of the pack. Additionally, the fact is that I think that there's something that mutual funds itself, because they're a pooled vehicle, they're required to deal with retail clients. People need their money in 1 day or 2 day, and you can't then just say, oh, sorry, these stocks are liquid. They end up being a bit more conservative than, by and large, than say a PMS or an AIF would have been. So I think both of these end up being counters as to why, even though you've made the point that yeah, sure, if you know what you're doing, a mutual fund is a great vehicle. The fact of the matter is that the mutual fund often fails and people don't end up using it well for whatever reasons.
I mean, this is also an important point because of the other problem that mutual funds have done. They've gone and created themselves as a pure equity investing instrument rather than in any way a meaningful solution. So, for instance, if I want to have asset allocation, I have to do it myself. I can buy a large cap fund, but I should know the difference between how much I should have in large caps versus mid caps versus small caps. A small cap fund by even, let's say, a quant has its largest allocation to Reliance Industries. So is it a small cap fund or is it a large cap fund? To me, if I have a combination of a large cap fund and this quant small cap fund, is my Reliance Industries now a bigger part of my overall portfolio? So it's like, oh my God, there's so many of these things that count. So how much mid cap, how much small cap, how much equity, how much debt? All of these are decisions that the investor has to take, and therefore the family office and advisor and so on, versus what a PMS can actually help you in that, saying, listen, I understand your risk profile, we'll do the asset allocation for you alongside with the actual equity investing. Not many PMSs do this. We started off doing this ourselves, and then we eventually realized our customers know enough to be able to asset allocate for the most part by themselves, but we do still help them in understanding their asset allocations and so on. Now, here's where the other problem happens. Let's say I decide, oh, you know what, I should go to mutual funds. There are a bunch of, how do I select mutual funds? Put them all in a list, rank them by 1 year, 3 year, 5 year returns, see the ones that repeat, and then boom, you're down. I do this. I buy, 10 mutual funds, 5 mutual funds, because they said you should have only 5. Next year, I go back and say, oh my God, this Parag Parekh, yeah, he was doing so well last year, and today he's like even lower than index returns. If I look at a 1 year return. Then I'm like, okay, you know what? I won't put more money into Parag Parekh, but there's this other quant guy who's doing really well. Let me put money into quant. So I redirect fresh money from X to Y. And so now I have an old Parag Parekh and a new quant. Now I have like 9 funds by this time. And a few years down the line, I have 40. So you have no idea what's going on. Then you go to somebody who's an advisor. He asks you to chop everything down into 5 funds which are currently doing well. And then, you pay a bunch of taxes because you did all this stuff. And eventually go to a PMS and say, I can't deal with all this. Just give me a standardized portfolio, And then within the mutual fund industry, you have you have to choose between regular and direct. So if direct is not regular, is it irregular? Is there something wrong with it that makes it like irregular? So, for you to understand this from the outside point of view, I think that is another painful part of this. And then there is growth and dividend. And dividend is not even called dividend. It's called IDCW, some distribution of something. By the time you kind of understand these terms, you're almost like, I need help just to invest in an instrument that was supposed to help me invest in stocks. I think that has been one of the major challenges with mutual funds complicating themselves by just adding too many menu options. And honestly, it's like a restaurant with a menu. You feel threatened, right? If a guy gives you a book the size of, the Mahabharata as a menu card, because you start and you go through, the first 17 pages are random drinks which you don't want to have. And the 18th page is the drink that you want to have. And then the 45th page is where the appetizers start. And then you're almost like, listen, if I don't have a PhD in understanding how menus work, I'm not going to be able to tackle this menu. So you go to the waiter and say, listen, just tell me what you eat or what you find interesting over here, but I'm not going to go through all this. And he's like, paneer butter masala, sir. And that's pretty much, how decisions will get made. But um, I think that part is where from the product side it's become complicated. But like you also said, there's a conservativeness. And that conservativeness is at some layer because you're managing public money. A lot of small people are putting 100, 200, 500 rupees and all that stuff. So like, I can't do something really stupid. That's why the small cap fund goes and buys the Reliance Industries. It has to have 65% in small caps. It does. Of the remaining 35%, it buys as many large caps as possible simply to give it this feeling of, listen, I know small caps are risky, but I should, because I'm handling this retail money, I should have some kind of non-small cap exposure as well. No, it's all right if the small caps are doing really well, but if they're not, or if it comes to a point where the large caps are not doing as well as the small caps, you will lag the index. You're actually not doing what you're supposed to be doing, but you do it for the sake of this. Now, the other problem is also that everybody wants money in one day. I go to mutual fund, I hit the withdraw. Within a day or 2 days, I should be in. Now, at some point, I hit the problem of size, right? Let's say there's a small cap. This is a small cap fund with 40,000 crores. At some point, this 40,000 crores is like if I invest in 100 small caps, that's 400 crores per small cap. And a small cap is a company that's less than maybe 15,000 crores. If I am 400 crores of a 15,000 crore company, I'm actually 3.5%. And this is a good thing because there could be a 6,000 crore company where I'm 8% of the company, right? So I actually own significant percentages of these companies. Now, if a bunch of my customers come and say, I want to get out right now, I'm going to have to dump this 7 or 8% into a market where I was the one who took it up because I was the one who bought it up in the first place. So this one day liquidity scares the daylights out of like the small cap fund managers, and then they go and buy the Reliance saying, if I get 10% redemption, at least I'll get rid of 10% of Reliance and I don't have a problem, getting out right now. But PMS actually can help because they can go down and do micro cap and SME investing, where you'll take maybe 6 months to 8 months to develop your position, and then you can actually say, listen, I'll give you your money back after a month, not after 2-3 days. I'll even have an exit load that says if you exit, I'll charge you 3%. In a mutual fund, the exit load goes to the remaining unit holders of that fund. In a PMS, it actually goes to the PMS company. So the idea there is that if you have an exit load, since you'll pay a certain higher fee, you kind of decide not to do it, and therefore you kind of stay on much longer. But what happens over here is that the caps also work. So for instance, as a PMS, I can set up 40% in one company. I can be 75% cash. You can't be that in a mutual fund. A mutual fund says, well, you know what, even if you want to be 75% cash, you can't be. Therefore, you have to stay invested. So at least 65% has to be invested in stocks. So you say, okay, well, fine, I'll be 65% invested. But that means you're 65% exposed to the market in case of a downturn. There's a stock that you bought, I don't know, at some price. And because it kept going up, it went 10x and you had a 5% position and now it's become a 20% position, the PMS guy doesn't have to sell it. The mutual fund guy has to keep selling it to bring it below 10% at all times. So that cap can ruin you because what happens is returns are disproportionate, right? You'll get one stock which gives you 100x return. And if you don't meaningfully allocate to it, that one stock is pretty much all the return you got. That was your thought process. That was the thing that you saw this company at 200 crores and it's become now 20,000 crores in market cap. Guess what? When it became 200 to 2,000, you had to sell a little bit. 2,000 to 4,000, you had to sell a little bit more. So your original position didn't compound at the same level. You invested in a bunch of other things, but you know what? You're not going to get so many of these 100x successes. You're going to get one or two of them. And a PMS can actually ride the whole way, all the way down, but mutual fund cannot.
I hear you. I'd also like to point out another thing is that even when a person becomes a super, I'll just use the word sophisticated or on top of it and knows exactly what they want, they seldom just be like, what I want is to give Quant Mutual Fund 2 crore rupees, by and large. In the people I've seen, even though it's clearly such a compelling, good performer right now, I mean, by and large. They are, however, willing to say, I'm willing to give this PMS 2 crore rupees or something to that effect. So I think there's also something about mutual funds that almost scare away large investors, where they're like, this is not built for me. Whereas a PMS, I can go ahead and do this. There's something about the PMS or the AIF that gives you the comfort that this is where this money should go in the first place. And it's really not a glamour thing. I mean, as I said, most of these view them. I mean, it is very much a vendor relationship. They're like, look, you're supposed to manage my money and help it work, do well. It's not a source of like whatever pride or something.
Or return. Yeah, I think that, there's another thing that I think there's fact is that while large sums of money don't come into equity mutual funds as easily, debt mutual funds get a large corpus because they're mostly corporate and so on. So while you'll find corporates also finding not that easy to invest in large amounts into a mutual fund that does equity, they will easily do 100 crores into debt and so on. So the larger sums are there. Now, why are people not putting large sums of money into so I think there are two aspects to it. One is who you are. So I'll give you the weirdest example. The US has a strange law called PFIC. The idea of PFIC is a passive financial investment corporation. So a person with a US green card or a US citizenship that's living in India can invest in a mutual fund, not a problem at all. Except the US says that if a mutual fund is a passive financial investing corporation, which means it takes your money, pools it, and primarily buys other stocks. So when you do that, or bonds, so when you do that, you become a PFIC, and the US citizen or resident, green card holder, even though they're resident in India, have to file US taxes according to US law. And the US taxes say that a PFIC investment is marked to market on December 31st of every year. This is a pain. Because the minute you mark to market, that means if I do a 40% return, I pay that 40% as income tax in the US. In India, there's no tax because I haven't exited yet in a mutual fund. Then the next year I exit in India, I have paid some taxes in the US last year, but they're not offsettable because they were not paid as capital gains. So India charges you another 12.5% or something like that tax. So it's just painful to have PFIC. Now, what happens now is that for the guy who is returned from the US and has a US citizenship, or, a lot of people now have come to a point where they were born in the US. They've turned 18 because they went, their parents went to the US and then they had them as kids, and now they're coming back. And I mean, they've come back a long time back, but the kid was born in the US, so they have US citizenship. Or you have a US green card or something like that. They're sitting in India, they're trying to invest in mutual funds, and then they find out this PFIC law hits them. What do? They have to buy a PMS. A PMS buys stocks for the most part. When it buys stocks, there is no PFIC rule. You're not investing in a private financial corporation, your passive financial corporation, you're buying it an active corporation. That's fine. So for them, a PMS absolutely makes sense. Now, one of the other things that would happen, and especially with large numbers, is like this, okay? I want to give you 50 lakhs. I want to give a mutual fund 50 lakhs. When I'll do an STP, because I don't want to give 50 lakhs all at once, why don't you invest in the market over 6 months? Now, when we get that as a PMS, we get this request quite a bit where we say, okay, Deepak, I think the market's a little high. Why don't we spread the investment over 6 months? But since you have to give 50 lakhs at one shot, you give the 50 lakhs, we invest that over, say, 6 or 8 months. Now, this systematic transfer plan, in a way, you invest in debt, and then every month you take out the money from debt and put it into equity until the equity is full. It gives you a kind of a glide path into equity. Except you actually want to know that your 50 lakhs which I gave you, I mean, why would I do it slowly? Is only because I think the market will go up and down and I'll get the whole thing, right? We found that a lot, because in our PMS, we compare them with equity from day one. From day one, you had 50 lakhs and it's compared to as if I had an index fund for the same time. So I'm going to compare your performance with the index at any point in time. Now you want that because that's why you kind of said, I'll do better than the index if I do an SIP over 6 months. That's what the theory was. What happens in a mutual fund is they don't give you any of this. So I will tell you that your 50 lakhs grew to 75 lakhs. But if you've done it with the index 100% all in at the beginning, you might have been 78 lakhs. So you're underperforming the index. If you invest in a mutual fund, you get none of these reports. So what happens is you put the money into a debt fund and then do a systematic transfer into an equity fund. The equity fund tells you the returns of only the money that you have put into the equity fund. The debt fund tells you the money that you put into the debt fund, but you don't get a consolidated performance of both put together, which then says, oh, well, so this is where a PMS in terms of the analytics might actually come better, because you may have multiple strategies and you'll be able to do a lot more work with them. Now, one of the things is that here specifically, I think the managers make a difference.
And I was going to give two examples of that. The two counters I have heard successfully is at least one of my friends, when was earning a very large amount of money, just blindly put the entire, say, salary net of whatever EMIs and stuff directly into the Parag Parikh mutual fund, and it did really, really well for him. Back then it was only one, I think, the long-term one, right, or the flexi cap, whatever it's called. And similarly, I've heard this one, I haven't experienced firsthand, but that when Prashant Jain used to run those, I guess it was HDFC top 200, 100, and whatever it was, people would also blindly put money there. And it did again very well for them. So there are a few counters, but it does seem to be very much the exception and not the norm when people treat mutual funds as just park my money here and stay.
This is so true, because at some point you trust people. So when you say Prashant Jain, you mean Prashant Jain and not HDFC Mutual Fund. So today, the fact that he has left HDFC Mutual Fund makes HDFC Mutual Fund a little bit less in your eyes compared to what it was when Prashant Jain was there. So because he generated such superlative returns in the early 2000s, he carried that weight with him for a long time. And people said, listen, I like this guy. He's got a smart philosophy. It doesn't matter that he's not doing as well as he was, but we're going to still keep our money with him. And we can keep significant chunks of our money with him because he treats our money like his money in terms of taking conservative decisions and so on. And it's the same thing with Parag Parikh. They've imbibed a philosophy inside of their organization so much that you know that everybody who comes in is going to have a similar view of that philosophy, and therefore will not do something really stupid. Like, for instance, you might never find one of these crazy momentumish stocks into their portfolio. They bought the Facebooks, they bought the Amazons, yes, but they never bought the Nvidias. I think, at least as far as I know.
We'll go check.
But I mean, I have a feeling that, they probably didn't, because that was more, a crazy a bet, because it was at 1,000 XP or something like that. But I think this idea of having managers, and I think we've talked about this, people, it is the individuals that change our mind. In the US, you had Merrill Lynch. There was a Merrill, there was a Lynch, and they were talking about this. They created the first retail mutual funds. There was Jerry Tsai in the 60s. There was Peter Lynch in the 70s and 80s. There was all these people exemplified investing. Even the most boring form of investing which is index funds, had to be personalized by a guy named John Bogle, to the point where he's called the father of index funds. If index funds were so great, why do you need a father? I mean, it is supposed to be completely automated and, you don't care what the stocks are and all that stuff. But you needed a Bogle. And when you needed a Bogle, it was the personality that drove you to believe that, well, I think he's got something right, because this seems like the right kind of a person. That is another reason why PMS managers get a little bit more popularity, because mutual funds have gone into faceless territory. Oh, we have a committee. We decide based on a committee rather than... So it doesn't matter who the fund manager. I can bet you this. Most people don't know who their fund manager is. You know Prashant Jain because he became famous and all that stuff. But a lot of people, funds that have fame today, they have fund managers whose names, I tell you, on most good days without the internet, you won't be able to tell me. Mire Asset Large Cap Fund. Fantastic fund till 2018. Then things didn't do so well because they switched it into a large cap fund. Performance is still decent. It's not that bad. But it is a fund whose manager you can't name. For the most part. Most people can't name it, even if they own the fund. So because you become nameless and faceless, you get a little bit less enthu from the really rich people, because they're like, Acha, what am I doing with this? I mean, is this just like an ordinary product where they're investing by committee?
But don't you want some level of anonymity and process-driven stuff in your investments? Do you really want to be dependent on the genius or the star, whatever factor of a particular person? I'll give you another example. We're naming all veterans from the industry, but I think you had told me this. Kenneth of Andrade was like this amazing, incredible fund manager at IDFC, and he drove some spectacular returns. And I think then he moved on to start his own funds and all. And perhaps, I mean, I've not checked, but I think they haven't done as well since, maybe. And so, or maybe they have actually, who knows? But the question here is, don't you want it to be like we're not dependent on one person, and what if they wake up on the wrong side of the bed, or if they get the future wrong? Don't you want like a process or a professional setup where it's not just linked to one person?
This is actually a fantastic point, because I think if you have a process, won't you have consistent returns over a period of time? I wish the answer was yes, but mostly investing happens in a crisis. In a crisis, you need human beings whose heads are on the line, and that is when usually things change. I say this despite us having quantitative strategies where we say we don't need to use our heads and we just continuously use it. But I'll tell you, the most difficult part in a crisis is to stick with the system. And the idea of having individuals behind a process is to ensure that they have the right ability to decide whether they should stick with the system or they should be changing the system, because you don't know and there's no right answer. And I think one of the problems with the process oriented thing is somewhere along the line, you lose the charm of the innovation that comes along with products. And I give you the world's most often cited example is the CEO of Pepsi joining Apple, because at some point, in 1985 or so, Steve Jobs was like, "Listen, I'm not doing anything well in my job. I think we've grown too big for me to, run Apple. So I need to get a proper CEO." So you found the guy he went and told him famously, "Do you want to sell sugared water or do you want to change the world?" And he said, "I'll come and change the world." And he ran the company as if he was selling sugared water. And when you have a sales marketing driven organization, not in the way that Steve Jobs would have wanted, where it was a lot of product innovation that was powering it, you would clash with a person whose idea was product innovation versus a person whose marketing, dynamics. He fired Jobs in the end. Jobs went on, built some Next and Pixar and God knows what, and some crazy stuff, changed the world in a different way. And then Scully didn't manage to change Apple meaningfully at all, because eventually people were like tired of it and all that. And Steve Jobs came back, fired Scully, got Microsoft to put 10% in it and so on. So there was this funda that Jobs rescued Apple. Right? So when things go wrong, you want to know who your fund managers are, because they're somehow going to rescue you from this crisis situation. And, at some level, there is a product innovation and differentiation that you can create as a product manager in a mutual fund, versus, you can't do much with a Pepsi, right? A Pepsi is a Pepsi is a Pepsi. I mean, it's Pepsi, but that's what it is. It's not they're not going to suddenly change the formula that makes it look closer to Coke, because then it would become not Pepsi and then it would not sell because it's not Pepsi. So the product differentiation is minimal and the marketing differentiation is great. So that's why you have Amir Khan ads for Pepsi, because that's the innovation you can do. But the idea of mutual fund products is the product itself can be different. I can invest in better companies. I can invest in different companies. I can invest with different weightages. I can do a layer of going to partly to cash and partly back. I can do derivatives. I can do call options. I can do this. I can do that. So I can do certain things with products. The minute you have that, you want the personality. It's not just the process. You want the personality that said, well, this personality has built this process, but whatever it is, this personality will take care of it, right? So you had a Vanguard that would run the bogle. And how do you know that your index fund is performing exactly according to the index? It could be by chance, because the guy you could buy the FANG 7 stocks and pretty much get the S&P 500 return for the last, in fact, more than the S&P 500 return for the last 6 years. How do you know that it's not somebody who just bought these 7 stocks and sitting and saying, dude, it doesn't matter, the remaining 493 stocks are a waste of time? You know that the person who's created this index fund has the discipline to have created a process that says you need to buy all the 500, because there's no way you can predict that the first 7 things are there. That means you created a human accountability layer, which is above the process. And that human accountability layer, what you're buying. Because the rich person, not just rich, but I think any person, but the poorer you are, the less choice you have of being able to move things around, right? Because if you're less than 50 lakhs, mutual funds are your only alternative. So here you're saying, I'm going to go with someone who meets my requirement. I don't say this is a necessarily good thing, but the personality helps. And the personality is what drives people to feel that my money is in good hands. People keep saying this person will take care of my hard-earned money. No money is not hard-earned. In the end, every piece of money that you earn is hard-earned, unless you won a lottery or something. So the fact that you give someone brownie points for managing your hard-earned money is almost irrelevant, because even if you had not earned it in the hard way, it is still money that needs to be managed.
But I think the point you're making here, which I've heard now, and I mean, so first, I'm not going to touch the Apple, Pepsi, and Coke examples, and I think you got the name of who does ads for what wrong, but that doesn't really matter. I think what does matter is your contention. And I think I've heard this a few times, and it does resonate that when it comes to financial services, you do kind of care who's the person on the other side, especially if maybe you don't care as much if you're taking money, but you certainly care if you're giving money. So whether it's a bank or an asset manager or a advisor or something, there you care a little bit about who's running it for various reasons. And I think that does at least gel with my personal experience. I don't know if you have anything more to say on that, but I wanted to move to, fine, so we agree a person matters, but then if it's the same person with an AIF and a PMS, what do you do? But anything further on the previous point?
So I think this came about recently, okay? That Piramal made a statement at some point in time when it was DHFL was in a crisis. He said the promoter owns too little of the company. So my ears shot up, because in the US, everybody owns tiny slivers of the company that they own. And in here, the DLF guy, the DHFL guy owned about some 17 or 18% of the company. And the Piramal guy owned some 40 odd % of his company. But he made a very simple point. He said, dude, if I own 40% of my company, I'm not going to let my company go down. I'm not going to do something really stupid in my life. And the DHFL guy, because he owned so little of it, decided that the company was not as important as he was, let us say, if that was the case. The point is the fact that many people told me this is a problem, but Piramal will fix this. Because he owns so much of it, his reputation on the line. I don't think this always works, because like you said,
there's counterexamples. Yes. Like, didn't Yes Bank do very badly? Yes, despite him owning a lot of it or whatever.
He didn't own so much of it, but he owned enough of it for
it to matter,
and he let it go. But yeah, there are those counterexamples. But by and large, you find that companies which have no promoters, unless they're very established and large, like L&T is, or like HDFC was. In fact, HDFC Bank now has no promoter either. There's no meaningful promoter for HDFC Bank. So unless you reach that layer of excellence, in a crisis, it's the promoter-run companies that intend to have some kind of a rescue mission that goes on. I'm saying this.
No, actually, I think I get it. I don't know whether this is true or not. Like if we have someone from our team sit and do an analysis, it may well turn out it's not true. But I think the psychology is what we're looking at over here, and people very much believe this to be true, even if it isn't.
Yes. In fact, if you look at it, why do people exemplify personality? It's today, for instance, if GST goes up, everybody shoots things to the finance minister. The finance ministry has almost zero take in what GST rate is charged for what. It's a GST council that involves all the states that decides this. But that person is responsible. You assign authority and responsibility to one person. Like somebody said, in the end, it's one person. Actually, this is a very bad thing, because it came from a Bruce Willis movie where this guy goes around killing people.
Sure,
this thing. But the idea was, he always said this, it always comes down to one guy or one girl, in whichever case you may. But going back to this, yes.
Yeah, fine. So you have identified the manager who you like, he or she. Now they have both an AIF and a PMS. How do you pick between these?
This is a great point. Now you got to a point where you got an AIF versus a PMS. A PMS has more transparency, because you have the ability to figure out which stocks you own. An AIF is blind. Similar to a way a mutual fund is blind, a mutual fund at least reveals you the portfolio once in a month. An AIF can choose to never reveal you the portfolio. He'll just say, oh, well, you know what? Your money is worth so much, and you have to believe it, and there's some regulations around it and so on. Now, a mutual fund system has been perfected over years, where you could go and now buy a mutual fund even without the consent of the mutual fund itself, because they have distribution. So you can buy it from a Zerodha broker, or your friendly neighborhood distributor, a bank, anybody. You don't have to contact the mutual fund to do so. But in a PMS or AIF, you actually have to contact the organization to do so. So you're going to have to,
or an empowered distributor or whatever. Yes.
So now, an AIF takes away one hassle from you, which is to file the taxes. In a PMS, you have to pay your own taxes. In an AIF, the tax thing is taken care of by you. So to compensate for that, if you like the manager, you're going to look at a product that has higher returns, net of fees, within the two. So you're going to say, oh, I'm going to look at the PMS, I'm going to look at the AIF. It obviously shouldn't be the same product. Now, why can it be why is it a different product? For one, in a PMS, while I pay the taxes on my own, certain parts of the system are very transparent and visible to me. The AIF has a layer that I can't see, but it allows for leverage at one level. So you can go 2x leverage. You could buy call options for more than the portfolio is worth, and so on. So this allows the AIF to make a slightly higher return, but obviously there's a slightly higher risk as well. It could invest in unlisted securities, which could give you a higher return. If it does that, then I think you might want to go down the AIF route by saying that it's doing something that is different and more spectacular than the PMS itself. Because if it's the same kind of, it's a PMS doing exactly what an AIF does, then, I don't think there's a meaningful difference between the two. Some AIF managers actually say we don't want any money in PMS. PMS is for the little guy. My AIF is where the real money. So they're actually saying we're running a substandard strategy in the PMS, but a super standard strategy in the AIF. In which case, you're naturally going to gravitate to the AIF if you meet the minimums. But the minimum of the AIF may be 5 crores. The minimum of the PMS is 50 lakhs. So between 50 lakhs and 5 crores, even if you love the manager, you're going to go to the PMS itself because that's how much money you have. So I think the same person or the same manager would be different, would make you want to choose either by their own credit or by their own returns or by their investing style. But let me flip it back and say that who you are determines what product to invest in. Like we said, PFIC. PFIC applies. PFIC is okay for a PMS, not for an AIF. AIF is also considered a passive financial investment corporation. So if you're a US resident or US citizen living in India, you would actually not choose the AIF and you would choose the PMS. Now, a few things that you might want to do is listen, I want a single NAV across all my different strategies offered by the same PMS manager. I might go to a PMS or an AIF, depending on what they do. If I want tax efficient investing, I'll do the mutual fund if I'm not a US resident and so on. So if I want higher returns, now this is where it flips away from being me and it's no longer my characteristic, but I do want higher returns for higher risk. Then you choose which instrument is actually giving you those higher risk. And I think by and large, this has become a function of size and manager affluence. So the size question would be that as you grow bigger and bigger in size, the number of companies that you can buy into in India become smaller and smaller. So now the biggest Indian mutual fund is nearly 80,000 crores. Parag Parikh.
They've hit 80,000?
80,000
Wow.
or something, 70 plus thousand crores. So you're at that rate, at the 80,000 crore rate, even if I have 100 companies, I don't think he has 100 companies. He has maybe 50 or 60 companies. But you're still buying nearly 1,000 crores per company. Now, the number of companies that you can afford to buy 1,000 crores for is now countable in the total number of companies you actually have. The 100th company in India today has a 1 lakh crore market cap. That means if you bought 100 companies with 1,000 crores each, then the 100th company you would own 1% of. So effectively, you're owning more and more percentage of. So what this happens is you just have to spread yourself too thin. You can't meaningfully take large bets, and until Indian market cap of Indian companies reaches a much higher degree, you're limited by the growth of the size of the mutual fund is greater than the growth of the market cap of all the companies. So in the sense that becomes your limiting factor.
So I think if I'd like to summarize the episode, so just coming to our conclusion, if in a world where all the products are actually equal, so all else equal, truly the mutual fund is then a better version of the PMS, which is a better version of the AIF. We get this. But the reality is all is never equal. Each of these ends up, you are a different person when you're looking at each of these, depending on how rich you are, what time frame you're looking at, what your tax circumstances are. And then when you look at the products, how big they are, what's their AUM, what's the investable universe, whether they're adding leverage, whether they have higher concentration. So you end up with actually a very complicated choice where the fact of the matter is the choice reveals more about you and your circumstances than it reveals about the instrument itself.
In fact, I think, the in my college, we were in a college in near Suratkal, young kids. So people would fall ill and we'd go to the doctor, and he'd always give us, no matter what you came with, you would get something called Calpol.
Oh, yeah.
Because he'd give you Calpol and he'll say, go and this will fix. So you could walk in with a broken arm and he'll give you Calpol, and with a headache, he'll give you Calpol. So the idea was one size fits all, right? And maybe the mutual fund is the Calpol. Like, you could literally suggest this to almost anybody, and yes, there will be a mutual fund that will meet your requirements. But after some time, you realize, you know what? I'm a US resident, a US green card holder. So a Calpol doesn't work. I need something else. The minute you get into these differentiated aspects, and because people are inherently different, they made their money in different ways. They have different layers of conservative approaches. Some people don't care about taxes as much as they care about the safety of their money. Some people don't care as much about. So because of these differences, and their advisor capabilities, because their advisors are like, I'm really good at understanding AIFs. But these mutual funds are very boring. They're much lower return. I don't know how to predict. But here it is, I can talk to the manager and get some idea. The minute you get all these differentiated aspects in place, you find that your true allocation might not be any one of them, but a little bit of all of them. You might find that, listen, I need a little bit of FD, I need a little bit of real estate, and then I need a bunch of equity mutual funds that do large caps, that do mid caps and small caps. I need one AIF for some unlisted, feeling good wala thing and some potential large growth. PMS for my micro cap and SME investing, which none of the mutual funds can actually do. So the minute you get into these, then you get into this. I have a bit of PMS, I have a bit of mutual fund, and I have a bit of this. Not one is the best for me, and some are actually the worst for me, but it depends on me and depends on what I want.
And I think the reason why this will never go away is because, as you pointed out at the beginning of our episode, when you get it right, you can make enormous amounts of money. And when that potential exists, and you can always end up getting, say, the better fund or the better PMS or the better AIF and beating the benchmark by 10, 20 or some insane number of percentage points, why will people ever stop?
A great way to end it, yes.
Thanks, Deepak. Well, thanks for listening. If you have suggestions for more topics or just feedback on this episode, then do email podcast@capitalmind.in. Otherwise, visit capitalmind.in to learn more about our insights on investing and see what our investing solutions are. Till next time.